Welcome to the EY NextWave Private Equity Podcast, where we explore what's happening now, next, and beyond in the world of PE. Digital, sector, talent, value creation, ESG. These topics are top of mind for executives across the global private equity ecosystem. Join us for the insights you need to reframe the future of private equity. Now, here's your host, Weena Brown from EY.
The transformation of business, society, and government has accelerated over the last decade, and what has emerged is the prevailing view that a company's primary purpose is no longer simply to enhance and protect value for shareholders through shorter-term profits, but that corporations are better able to deliver long-term value to shareholders when they understand and address the broader needs of their customers, employees, investors, regulators, and other key stakeholders. So, in essence, we're seeing a shift from shareholder capitalism to stakeholder capitalism, as value is now being seen not only through a traditional financial lens, but also through non-financial measures. Today, we're going to explore how PE is embracing the principles of long-term value, or LTV, which is the holistic strategy that a company embraces to increase its long-term value to its stakeholders, as well as ESG, which stands for environmental, social, and governance, and is more specifically focused on how a company activates, measures, and communicates the impact that it's having on the environment, society, and its own governance. ESG is driving long-term value for stakeholders through transformation, reporting, and disclosures. Joining me today are three of my fellow EY colleagues: Eric Buchan, who's the leader of our long-term value focus at EY; Curtis McLaughlin, who is a long-term value campaign specialist and innovation leader; and Rich Good, who is a leader in our climate change and sustainability practice, which focuses on building and implementing ESG programs for our clients. Gentlemen, welcome to the podcast. So, Eric, let's start with you. In what ways has the shift to long-term value disrupted the world of private capital?
Disruption is really causing companies to pause and reflect on how do we create value across a broader group of stakeholders in today's environment with all the crazy things that are happening around the world, and how can we really develop a more holistic view? We're going to talk about ESG, environmental, social, and governance, which is really a key driver of long-term value for many, many organizations. And it's great to see the prominence of ESG, the momentum around ESG, but we also don't want to forget the holistic view of other parts of the business that create and protect value for an organization, meaning around innovation, the customers, consumer trust, brand, et cetera. So there's a lot of other areas that companies are also looking at that complement the long-term value narrative. And so I think asking and reflecting these type of questions is really important for organizations, and particularly in the private equity space. There's an added complexity because you have now not only the management companies, direct employees, and communities that are being impacted, but you also have to think about the funds, the LPs, the portfolio companies within the funds, and really start to ask questions around, if we're looking at the whole portfolio, are the companies within the portfolio kind of aligned to our purpose and strategy? Are the companies within our portfolio really challenging themselves to maintain a competitive advantage, and what are they doing to redefine their business and measure and communicate around that in a consistent way? So I think it's really raising the bar now for organizations, and it's even becoming a board level topic. We're seeing the agendas at boards kind of reflecting a lot of the things I just talked about. They're asking questions in the board now that they really never used to focus on as much. So I think all these items coming together really create it's a pivotal time for business, and a really important time to take not only practical steps, but very strategic steps to do the right thing. I think it's also important for our society and for the world that everyone get behind it.
Well, yeah, Eric, that makes a lot of sense. I mean, it's great to have these big concepts and big ideals, but I guess the big challenge is, how do you make it sticky, and how do you pivot into a long-term value-oriented strategy? Curtis, what have you seen as some of those biggest challenges?
One of the biggest challenges I see is turning the stakeholder capitalism from a public relations talking point to really integrating it into the organization. For example, in the last few months, we've all seen the issue of systemic racism, racial equity, social justice come to the forefront of a lot of conversations, including the LTV conversation. What we saw from a lot of organizations was somewhat of an immediate response to recent devastating events by way of a lot of big, bold statements denouncing racism, promoting social justice, and the announcement of numerous companies of their commitments to support minority communities in which they operate in, and also internal initiatives to support their underrepresented minorities that work for them. Because a lot of organizations felt societal and consumer pressure to act quickly and inform their customers of their values and where they stood on these issues, a lot didn't take the time to think through critical questions before making some of these commitments. For example, what outcomes do we wish to achieve for our stakeholders through our new commitments and initiatives? Or do our investors and employees understand our strategy and the business purpose as to why we've made these commitments and how they drive long-term value for all of our stakeholders? To apply an LTV-oriented strategy, you need a clear, consistent communications to your stakeholders, and there needs to be a link between your activities and your overall strategy.
So, Curtis, that's a really good point. Clearly, the world is moving very quickly, and there is a lot of pressure to have a stand and make commitments around long-term value. But on the flip side, how would not having a long-term value focus and strategy impact a PE's ability to attract as well as retain LP investors, even if at the back end, they have to kind of fill in how they're going to execute on that strategy?
Great question. The shift from shareholder to stakeholder capitalism is really continuing to just gain momentum with a growing focus on measurable long-term value creation. In today's day and age, in the absence of a company effectively reporting on these non-financial value categories and framing their own value story or narrative, is increasingly easy and common for third parties to come up with their own assumptions and a potentially damaging narrative of their own with no context or validation from the underlying companies, which honestly could deter investors. Organizations that aren't focused on these issues are being impacted as consumers, employees, and investors are now utilizing their spending power and influence to make a financial impact on these companies they no longer believe share their values. In addition to a number of consumer boycotts we all heard in the news recently, large institutions are considering non-financial metrics and determining where to allocate capital and with whom they do business with as well. And there's already a couple, high-profile examples of this. Earlier this year, Goldman Sachs, who's made public commitments about driving diversity internally and externally, for which they know they'll be held accountable for, announced that they will only underwrite IPOs in the US and Europe of private companies that have at least one diverse board member starting this year. And in 2021, they plan to raise that target to 2. Additionally, earlier this year, State Street issued a letter speaking about their new R-Factor scoring system, which will measure from their lens both the performance of a company's business operations and governance as it relates to material ESG issues. They also said they believe that a company's ESG score will soon effectively be as important as its credit rating, and that they will begin to take voting action against board members at companies with bad R-Factor scores that haven't articulated how they plan to improve them.
So, Rich, I think of ESG as a key pillar in the broader journey to building a strategy around long-term value. And we're clearly hearing more and more of a buzz around ESG, as Curtis was just outlining, and specifically private equity is very focused on ESG. Would you say that it's an imperative, or do you think it's more of a kind of check the box exercise?
Hey, nice to be with you here today, Weena. That's a really great question. Look, we're all familiar with what the big banks have done, and they're really public pronouncements about ESG. Some saying going so far as they're going to use their proxy power to vote against companies that fail to report on ESG and climate-related issues. PE firms up to recently have been a little bit immune from that, where a lot of them said, "Look, ours is fundamentally a short-term strategy." But the conversation has really shifted. 2020 has been quite a year for a lot of reasons that we'll discuss. But I see a lot more PE firms coming to us now saying, hey, look, we're feeling pressure from these big banks, all the attention they've given to them. In the past, some PE firms, not all, have performed what we call a negative ESG scan. And that just weeds out companies that engage in certain activities, maybe making weapons or tobacco or something like that, and then weed out those to appeal to a limited set of investors. But clearly, that's not enough anymore. PE firms, like any other investor, are competing for capital. I'll say that again. PE firms have to compete for capital just like any other financial services company. And ESG funds, by the way, are the fastest growing type of investment. So to attract that capital, PE firms really have to pay more attention to these ESG issues and clearly state, hey, this is how we articulate our ESG strategy. This is how we weave it through our investment decision-making process. And honestly, here's the products that we have to attract those ESG funds. So really, it's moved way past nice to have and become a business imperative. And investors are increasingly asking PE firms what their stance on ESG is, really to make sure that where they're putting their precious investment dollars align with the interest and the core values. So for a PE firm, that this means more than just issuing a sustainability report or an ESG report. Just remember, it's what I tell all my clients, your report is the outcome of your program. The hard part is integrating ESG into all aspects of your business, from your talent, D&I, diversity and inclusion programs, as well as your core fund offerings, and ultimately how you invest in your targets. So when it's really become more of a business imperative, especially over the last year.
That makes a lot of sense. But when you see it in action, where are you seeing or how are you seeing PE focus on ESG? I mean, this has moved really quickly. Are they dealing with it at the front side or throughout like existing portfolio companies? Are they going in there and saying, hey, our purpose has changed and we need to shift and have a stronger measures around ESG? How are you seeing it manifest itself?
It's really been fascinating how it's changed in the last year. The pace of change here has been really remarkable. So in the past, we only really saw some of this on the buy side of a transaction. So if a company was going to buy another company, oftentimes they'd send a drilling rig out and start taking core soil samples. And the old joke was, for every time you drill into the ground, there's $1 million in value you just lost. So it was really almost just to make sure you're not buying a toxic Superfund site to clean up or something like that. And to be clear, that still happens. But now we're looking a lot deeper past environmental issues. And I'll talk later about this sort of shifting beyond just the E and ESG. But now you're looking at maybe, did they have a labor issue in the past? Looking at actually the management team. What is their past? Have they been caught up in any sort of shareholder lawsuits or things like that? So it's really diving deeper into ESG issues and looking at things like greenhouse gas emissions, diversity metrics, how they treat their employees. So that's one. So we're seeing deeper upfront on the deal on the buy side. But interestingly, more and more, we're hearing from PE fund managers saying, look, we've invested in these small companies. We're ready to spin them off to the capital markets, IPO or something like that. Will you help us develop an external ESG presence before they approach the capital markets for IPOs and so forth? Simply because, as Curtis had said, your PE score will clearly become as important as your credit score. So to have a company go public with no ESG posture or stance, even however basic, is really a swing and a miss nowadays. So we're seeing more and more that PE companies saying, look, we've invested our investors hard-earned money. We've developed this company. They're ready to go public. An essential activity is to have an ESG stance. So understand what your material ESG issues are, what's your plan, what's your strategy, and you have some metrics, goals, and targets around there. So that's really been sort of some of the shift we've seen in terms of ESG in the PE fund deal or fund lifecycle, Weena.
Clearly, then there's been an acceleration, if you will, or an acceleration of the focus on ESG over the last year. And we've had numerous discussions on the podcast about how COVID has accelerated, innovation, disrupted the supply chain, has changed how private equity firms view working capital, et cetera. Do you think that COVID has been a driving force behind the ESG conversation in private equity?
I would say that COVID, along with a few other key issues in 2020, have really helped shift the ESG conversation. So just a couple of things, really top front and center is racial equity and social justice issues. We have COVID in terms of how companies are treating their employees. That's a really important E or S or social consideration. Then you have added to that extreme weather events, wildfires. They've all contributed to and accelerated the conversation around ESG. But to me, I still think a lot of people, when you talk to them about ESG, they think about the E only. Greenhouse gas emissions, carbon footprint, maybe water, waste issues, things like that. But ESG is so much bigger. And where COVID falls is under the social and the governance part of ESG. These issues have really come front and center due to the unprecedented events this year in 2020. But furthermore, these issues are not going away anytime soon. And companies and PE firms that don't report on the material ESG issues will soon be the exception, not the norm. So what does that mean in reality? PE firms are a lot like other companies, right? They need to attract top talent, they need to attract capital, and they need to provide a return to their shareholders and investors. That means they should also be doing what other leading companies are doing, which first means understanding what their key ESG issues are, figure out how that impacts your strategy, and report transparently on the results. Going forward, there are likely to be more regulations around ESG disclosures. For example, we have the SEC's recent change mandating reporters report on human capital issues. So rather than waiting for regulation, which is expensive, PE firms need to balance changing investor demographics and demands with the need for solid returns. And luckily for them, many studies have shown that companies with higher ESG scores outperform the market, even during the COVID market meltdown. Even ESG funds during the market meltdown were less volatile and recovered faster than their non-ESG funds. So I think COVID was one of the many issues that force investors and others to look at PE firms and ask them, how are you treating the companies that you've invested in? And for companies, all other public companies, saying, how did you treat your employees? Where did you put your money? How did you support them? If you availed yourself of the PPP program, the market clearly wants reporting on this. And I do think that COVID will have a long-lasting effect on not only us as a society, of course, but on ESG reporting, particularly stronger reporting on the social and governance aspects of ESG.
Well, 2020 has certainly been a year of a lot of disruption and a lot of change, but it sounds like at least there's some good that's coming out of all of the impact of COVID and the racial issues coming to the forefront, in that at least now we're having a really strong focus and an accelerated focus on S&G, as you've pointed out, which is going to be really important going forward. Eric, we're seeing a lot of press around long-term value and purpose. Guidelines just came out from the SEC around human capital, as Rich mentioned. The United Nations Development Program just released standards for PE to assess how they can contribute to the Sustainable Development Goals, and also the World Economic Forum report, which I know you've been pretty close to. Is there currently a global consensus around what LTV means and how it will be measured?
The point around global consensus, it's great to see that we're actually moving towards that in the release of the World Economic Forum and the International Business Council report that just was released last month is a great example of that. I mean, we think about what went into the development and the fine tuning and the release of that report is unprecedented, really. We had over 120 plus CEOs that make up the International Business Council. The chair of the International Business Council is Brian Moynihan, CEO of Bank of America. And we also had all the big four represented, Deloitte, EY, KPMG, and PwC, coming together to really work on a refined set of metrics, 21 core metrics, 34 expanded metrics. And it's a great step forward to identify, universal material ESG metrics and disclosures that can be consistently reported on. And I think it's a great step that will help companies embrace this, but also it will have the most impact if we can link it back to a company's strategy, purpose, and alignment to expectations of the stakeholders. And so this creates a great platform to not only report on those really important ESG metrics, but also contemplate what other value creation levers exist in the business, aligned to customers, innovation, trust, brand, et cetera. And so I see this as a really positive development and one that I would encourage everyone to really take and reflect on in their organizations.
Yeah, I completely agree. Having a consistent and comparable way to measure sustainable value is critical. But I guess also what's critical is having that strong tone from the top, the leader of an organization who has a clear vision and really sets the tone for everyone to follow. Curtis, in your view, who in the PE complex ecosystem should lead the creation of their long-term value, strategy, and purpose to really make it stick?
So that's a good question. And unfortunately, I think I'm going to give everyone's favorite answer. It depends. And it really does depend on the organization. I think the key is developing and executing against a compelling, purpose driven, stakeholder focused strategy, touching on a broad set of areas, including, again, the employee experience, the customer value proposition, supply chain management, capital allocation decisions, and leadership incentives. And all of that will be different for different industry participants. So it's not going to be a one size fits all. I think I touched on it previously, but companies frequently fail to link their strategy, underlying operations, and measurement frameworks together. The most impactful metrics for reporting long-term value are those which are closely linked to a business's strategy, strategic assets, and value creation levers. And again, that's going to be pretty bespoke and different for different organizations.
Okay. And Rich, I know that there are some really prominent funds whose strategy is to invest in companies whose primary purpose is to better society as well as make financial returns. However, let's face it, not everyone is necessarily convinced that ESG investments will be able to deliver the returns that investors want in the long term. And then when you add or you apply the demanding performance expectations and high level of scrutiny of typical PE, I'm guessing that making ESG work in this environment poses a challenge. So I've got two questions for you. What do the non-believers say, and how would you rebut their arguments? And secondly, is it really have to be all or nothing? I mean, can you not just have a company who focuses on ESG as core principles and still makes a profit, but brings in the E, S, and G elements that society and investors want?
I think I'll take your second one first, which is it all or nothing? And I often see companies say things like, we are what truly sustainable. And sustainable, if you go back to the initial definition of sustainable, means you're giving back or putting back more into the environment than you take out. And there aren't many companies that hit that bar. It's really a matter of doing less bad on your journey to doing good. So clearly, ESG fund managers, ESG NGOs, the ratings and ranking agencies, they aren't asking companies to, hey, look, would you please go out of business so you can save our environment? That's not really the goal. The goal is that, and I think we look at this in terms of risk, but let's not forget that not all risk is bad. There's a lot of opportunity here as well. So PE and other investment firms, clearly they have a fiduciary duty to provide returns to their clients, full stop. We understand that. But more and more investors are putting their money into companies that provide a positive societal value, or at least actively engage in activities that don't cause harm. So we're looking back at profit at all costs, which has really landed us somewhat in the position we are today in terms of environment, inequality, and some of the other issues we talked about. And furthermore, there's this massive transfer of wealth occurring. We in the United States here especially have it's a bimodal distribution in terms of our generations. We've got lots and lots of baby boomers, not so much Gen Xers, and lots and lots of millennials and Gen Y, Gen Z, and sort of what we're calling the younger generations now. A lot of that money is moving from boomers to millennials. And what drives this next generation is very different than what drove prior generations. And PE firms and others really need to be aware of this shift if they want to get that money. So we're not talking here about trying to convince you of climate change and close your operations and things like that. Just really recognize the shift in the market, that this is where the investment dollars are. And if you want to get your share of those investment dollars, you're going to have to treat this seriously. I also want to go back to something I said, risk and opportunity. And one of the frameworks out there, and admittedly there's a lot of them, is called the TCFD, the Task Force for Climate-Related Financial Disclosure. And what I really like about that framework is, as companies go through this framework to help understand their climate-related risks, there's the usual suspects, rising sea levels, rising temperatures, less rainfall, more rainfall, wildfires. let's not forget opportunities. There are so much in terms of opportunities in the market in the transition to a low carbon economy. We're seeing more and more examples every day. We're all familiar, of course, with Tesla and the electric vehicle and their valuation being bigger than some of the traditional automakers that have been around for 100 years. That's just really kind of shows that there's a strong desire to invest in companies that represent the next generation of market gain. And honestly, for me, I don't really see it as my job to convince anyone about climate change or anything like that. I don't care if you believe in it or not, but really facts do help. And a couple of quick facts. 1 in 4 investment dollars now flow into ESG funds, and that number is growing exponentially. So there's competition for those investment dollars. Number 2, MSCI, one of the ratings and rankings agencies, they cited in a recent survey lower cost of capital for companies with better ESG scores. So now we're talking real money. This is where the CFO starts to take interest. 3, during the initial COVID market sell-off, we mentioned that companies that had funds that had an ESG focus experienced lower volatility and faster recovery than non-ESG funds. And in short, where you have to follow the money. Where's the money going? That the world's changing, and so is investor expectations and what peers and competitors are doing. So really, I think to go back to this, is it all or nothing? Nope, it's a journey for sure. But when you're looking at non-believers to rebut their arguments, it's really just focus on the facts. If you follow the money, you will find the returns, and I think that's really important that PE firms focus on that. This is where the investment dollars are going. And if you want your fair share of that, you're going to have to at least start by having 1 or 2 ESG focused funds. That you still have O&G and other, other types of maybe non-environmentally friendly investments in certain portfolios, but and there's still a demand for that. I think fossil fuels will be with us for quite some time. It's going to be a slow transition, but clearly the market's changing, the world is changing. You want to be a part of that, not left behind.
Follow the money. I love it. That is perfect advice. Now, having said that, let me ask you, if you put yourself in the shoes of a fund manager or a portfolio company CEO, and he's sitting here and he's going, I know where the money's going. I know what I have to do. But it's daunting, right? It's different. It's new. They've never had to go down this path before. So what would you recommend? What are the actions that you think they should take to start this journey and get the ball rolling?
Sometimes, I say that fund managers need to follow the 5 stages of grief: shock, denial, anger, depression, then ESG, acceptance. So I frame this up in a now, next, and beyond context. What do we do now? First, understand the core ESG issues that are important not only to your firm, but your key stakeholders. That means your employees, the best and the brightest people you're trying to attract. That means your clients. That means regulators. What are the ESG issues that are most important to them? And then if you map this out, you'll see there's a small subset of issues that are important to you as well as your key stakeholders. That becomes your ESG focus. The next, report on those ESG issues and report on them with metrics and goals and how you're managing them. Don't focus just on pretty pictures and meaningless, things that are meaningless. Really focus on the core quantitative metrics. What are you doing about it? If greenhouse gas emissions are an important aspect for you, measure that and report on it. If D&I is an important issue for you, measure it and report on it. So report transparently. And finally, beyond, leverage what you learned and gained by integrating ESG in your business to articulate how ESG creates long-term value for you and your key stakeholders.
That is great advice. And the way you set it out really just makes it easy to follow. So I hope all the fund managers and CEOs out there listening takes this to heart and really gets that ball rolling. Gentlemen, I really want to thank you for all your time today and for your insights. This is very definitely an exciting time in not only the business world, but for all of us in the world. It feels like the momentum behind long-term value and ESG is really almost like an unstoppable force. And the time is now for private equity to take action and expand how they define and execute on value creation in their portfolio companies. And I would suggest that those PE firms who are early adopters and who lead this change in mindset will reap the benefits for years to come, as will all their stakeholders. Gentlemen, thank you again.
Thanks, everyone.
Thank you.
Thanks for tuning in to the EY NextWave Private Equity Podcast. For more thought-leading perspectives and to get in touch with Weena Brown, visit ey.com/private equity. You can also follow us on Twitter at EY Private Equity. We'll see you on the next episode.